Welcome everyone to today's presentation, Women and Retirement. My name is Kim Kennedy and I'm one of the financial consultants with Alliant Retirement and Investment Services. I am confident that you will benefit from the information we will provide today. I look forward to getting to know you and answering your questions. I must also point out that there is no perfect tax management strategy. Every choice has benefits and limitations. No single approach is right for everyone. At Alliant Retirement and Investment Services, we don't believe there's a one-size-fits-all strategy. In this presentation, we will provide information about 8 key topics regarding taxes. Our team at Alliant Retirement and Investment Services is focused on helping you understand the ins and outs of investing, saving for retirement, and much more. Take a look at our website, ARIS.Alliant at AlliantCreditUnion.com, and you can see the list of our weekly webinars, our podcast, and our blog and other financial resources on our website. There's a variety of ways that we could help you. As you can see, retirement planning, investing, life events, and generational planning. We'll touch on savings challenges you may face, the impact of taxes and inflation on your investments, and the income you'll have in retirement. When it comes to saving for retirement and planning for retirement income, women face a number of challenges. We'll discuss those in more detail. First of all, women generally live longer than men, which means they may need to plan for more years in retirement. Because of their longer life expectancies, women should also consider that they may spend some of their retirement years living on their own. Women often interrupt their careers to care for children and aging parents. Because of these career interruptions, women may spend less time in the workforce and earn less money than men in the same age group, which could result in saving less for retirement and having a lower Social Security benefit. It's important to recognize each of these challenges and plan accordingly. Let's look at each challenge a little more closely. As you can see, there's a higher likelihood of women living on their own, whether we're married, widowed, or divorced. Women are more likely to take time out of the workforce to raise children and or care for aging parents. Sometimes this is by choice, but moving in and out of the workforce has several significant financial implications for women. Lost income and employer benefits such as retirement benefits and health insurance. Lost income means potentially lower savings and a smaller Social Security benefit. This is because your benefit is based on the number of years you've worked and the amount you have earned. Economic vulnerability in the event of a divorce or a spouse's job loss. Possibly a more difficult time finding a job or a comparable job in terms of pay and benefits when re-entering the workforce. And even women who do remain in the workforce are much more likely to request flexible work schedules to meet their primary caregiving responsibilities, which can affect their salaries and long-term career advancement. And women generally earn less than men. According to the Bureau of Labor Statistics, women who work full-time on average earn 82% of what men earn. This wage gap can affect overall savings, Social Security retirement benefits, and for those who have one, a pension. It also means women are more vulnerable to unexpected economic obstacles such as a job loss, a divorce, single parenthood, an illness, or the loss of a spouse. Because of these special challenges, planning for retirement is especially important for women. So where do you start? Well, the first step is to ask yourself, how much annual retirement income will you need? It's often stated that you should plan on needing about 60 to 90% of your pre-retirement income when you retire. The appeal of this approach lies in its simplicity, but general guidelines like this aren't really very helpful because they don't take into account your individual circumstances, expectations, and goals. It is fine to use a percentage of your current income as a benchmark, but it's more important to focus instead on all of your current expenses and really think about how those expenses will change over time as you transition into retirement. For example, some expenses like mortgage and the cost of commuting to and from work may disappear during retirement. Other expenses may increase, like yard care services, snow removal, or home maintenance, things you might currently take care of yourself, but may not want to or might not be able to in the future. And if you'll be using your newfound free time in retirement to travel or take up new hobbies, you'll need to factor in those additional expenses as well. Though it may be difficult, try to list all of your expenses and project how much you'll be spending in each area when you retire. When you estimate your projected expenses in retirement, you can't assume things will cost the same as they do today. You'll need to consider the impact of inflation on those expenses. Inflation is the risk that the purchasing power of a dollar will decline over time due to the rising cost of goods and services. Inflation is often overlooked when planning for retirement, but unless you take inflation into account, you may underestimate the amount of annual income you will need in retirement. If inflation runs at its historical long-term average of about 3%, a given sum of money would lose more than half of its purchasing power in a 25-year period. For example, assuming a 3% inflation rate, a gallon of milk that costs $4 today would cost $8.38 in 25 years. All other things being equal, inflation means that you'll need more retirement income each year just to keep pace. And to outpace inflation, you should try to have a strategy in place that allows your income streams to grow throughout retirement. Like inflation, taxes are another important but often overlooked aspect of retirement income planning. Taxes can eat into your income, significantly reducing the amount you'll have available to spend in retirement. You'll want to make sure you understand whether the income you're counting on is or is not subject to tax. For example, private pensions are generally fully taxable. You might be surprised to learn that a portion of your Social Security benefits may also be taxable, depending on the filing status and total annual income. Keep in mind that some income, like interest, is taxed at ordinary income tax rates. Other income, like long-term capital gains and qualifying dividends, currently benefit from a special and generally lower max tax rate. And some specific investments, like certain municipal bonds, generate income that can be exempt from federal income tax and sometimes state tax as well. You should also understand how distributions from tax-advantaged accounts like traditional IRAs and 401ks are taxed. Generally, distributions from these accounts are taxed as ordinary income, regardless of whether the investments within the account may have generated long-term capital gains or qualifying dividends. Special rules exist for Roth IRAs, Roth 401ks, Roth 403bs, and Roth 457s. Qualified distributions from these accounts, which are funded with after-tax dollars, are free from federal income tax. Now that we've talked about how much annual retirement income you'll need, we should discuss how long that retirement income may need to last. When it comes to your retirement, how long a period should you plan for? Well, the good news is that we're living longer. The bad news is this generally means your retirement income will need to last for a longer period of time. As I mentioned earlier, the average 65-year-old woman in the United States can expect to live another 20 years. So it is not unreasonable to plan for a retirement that lasts 25 years or more, which means your income and your savings will need to last that long as well. A recent LIMRA study of women aged 25 to 70 showed these top 5 trending concerns across all categories. Managing debt, that's credit cards and student loans, saving for retirement, compensating for unexpected expenses and inflation, ensuring your family will be financially secure if you die or your partner dies, and outliving your retirement savings. Everybody's concerned about that, regardless of your age, your affluency. It's something to absolutely think about. Where will your retirement income come from? Traditionally, retirement income has been described as a three-legged stool, comprised of traditional employer pension income, Social Security, and individual savings and investments. According to the Pension Rights Center, only about 22% of all workers have a pension. That's about 137 million full and part-time workers overall. The first two legs of this stool, employer pensions and Social Security benefits, produce a steady or relatively fixed stream of annual income that you can depend on during retirement. So we've looked at pension as a possible source of your income. Now we're going to look more closely at Social Security. And after assessing your income sources and subtracting your estimated expenses, you're likely going to discover a gap. Pension benefits can be complicated, and it's important to understand how they work. A typical pension benefit is payable monthly over the plan participant's lifetime. Starting at normal retirement age, for example 65, this is called a single life annuity. However, once the plan participant dies, the benefit payments end, even if only a single payment has been made. If you're married, federal law requires that benefits be paid as a qualified joint and survivor annuity, or QJSA, unless both you and your spouse agree to receive the benefit as a single life annuity or in some other form. The QJSA pays a monthly benefit to the plan participant and then continues to pay between 50 to 100% of that amount to the surviving spouse after the plan participant dies. The amount paid to the plan participant during his or her lifetime is generally smaller than under the single life annuity because the benefit is payable over a potentially longer period of time, for example, 2 lifetimes instead of 1. If you're entitled to a pension, your choice of whether to receive the pension benefit as a QJSA or in some other form may be one of the most important benefit decisions you'll make for your retirement. Let's look at an example. These numbers are purely for illustration and are not meant to reflect the exact benefits that any particular plan may provide. Suppose your spouse retires at age 65, having earned a pension benefit of $4,000 a month payable for his lifetime. This is his single life annuity benefit. Because he's married, however, the pension benefit must be paid as a QJSA, unless both of you agree to choose the benefit in a different form. Because the QJSA is payable over a longer period of time, both of your lifetimes, the amount paid to your spouse while he's alive is reduced. Let's assume that under the QJSA, your spouse will receive $3,800 each month, and after his death, you'll receive 50% of that amount, or $1,900 per month. This is called a 50% qualified joint and survivor annuity. You may also have the option to receive up to 100% of the amount your spouse was receiving during his lifetime. In this case, because your survivor benefit is higher, your spouse's benefit is reduced again. Let's assume in this instance that your spouse's monthly benefit under the QJSA will be $3,600 during his lifetime, and that you will receive the same amount, $3,600, after his death. This is called a 100% qualified joint survivor annuity. Now, you may be tempted to take the higher single life annuity because it provides a larger monthly benefit now. But this option would provide no benefit to you once your spouse dies. As we've discussed, because women are more likely to survive their husbands, waiving the QJSA and taking the single life annuity instead will not make sense in most cases. Now, conversely, if you have the earned pension benefit, it may make more sense to waive the QJSA and you take the larger single life annuity benefit because of the likelihood that you'll survive your spouse. Ever since 1940, when a legal secretary named Ida Mae Fuller received the very first Social Security retirement check, women have been counting on Social Security to provide much needed retirement income. Social Security also provides disability and survivors benefits, but today we're just going to focus on the retirement benefits. Today, 90% of U.S. workers are covered by Social Security. Social Security is the major source of guaranteed lifetime income for most Americans. For some women, Social Security makes up most, if not all, of the income they'll have in their later years. To qualify for Social Security retirement benefits, you have to work in a job that's covered by Social Security, and you generally need to have earned 40 credits, which is about 10 years of work. If you haven't worked long enough to qualify on your own, you may qualify for spousal benefits based on your spouse's work record. A spousal benefit claimed at your full retirement age is generally equal to 50% of the primary earner's benefit. Now, how much can you expect to receive from Social Security? The amount you'll receive from Social Security is based on the number of years you've worked and the amount you've earned. Your benefit is calculated using a formula that takes into account your highest 35 earning years. If you earned little or nothing in several of those years, it may be to your advantage to work as long as possible because you might have the opportunity to replace a lower year of earnings with a higher year of earnings, potentially resulting in a higher retirement benefit. You can get an estimate of what your monthly Social Security retirement benefit will be in the future by visiting the Social Security website and using the retirement estimator tool, or you can view your own personalized Social Security statement online. Your statement contains a detailed record of your earnings as well as estimates of your retirement and survivor and disability benefits. If you haven't registered online to view your restatement, you'll receive one in the mail every 5 years, from 25 to 60, and then once you turn 60, they send those out every year. The age at which you start claiming benefits will also affect the amount you receive. You can choose to start taking retirement benefits as early as 62, but if you do, your monthly benefit will be 25 to 30% less than if you had waited until your full retirement age, which is generally 66 or 67, depending upon the year you were born. On the other hand, you will get a higher monthly benefit if you delay claiming Social Security benefits until you turn age 70. If you do so, your monthly benefit will increase by 8% for each year that you delay taking benefits past your full retirement age. If you've been married 10 years or more, you may be eligible for benefits for spouses and ex-spouses. Current spouses must be 62 and wait until their spouse begins taking Social Security to receive a spousal benefit. If you're divorced and at least 62, you can file for divorced spouse benefits even if your ex has not claimed benefits, and you can receive up to half of what your ex-spouse would get. If you're widowed and are age 60 or older, you can collect a survivor's benefit. The Social Security Administration website has a lot of helpful information to answer any questions you might have about your retirement benefits. This chart illustrates what a hypothetical person might receive by claiming Social Security benefits at different ages. It's based on a full retirement age of 66 and a benefit of $2,000 per month. As you can see, if you start taking benefits at age 62, you would receive $1,500 per month. But if you wait until age 70, you would receive $2,640 per month, which is about $1,000 more. Remember, this monthly benefit is guaranteed every month for as long as you live. So an important question as you approach your 60s is whether you should begin taking Social Security benefits early at 62 and receive smaller payments, but possibly receive them for a longer period of time, or wait until full retirement age or even later to start taking benefits and receive larger benefits over a possibly shorter period of time. You know, there's no single right answer for everyone. This is an individual decision that must be based on many factors, such as other sources of retirement income that you may have, your life expectancy, your marital status, whether you plan to continue working after you take benefits, and your tax picture. So the bottom line, though, is that for most women, Social Security alone is not going to provide enough income in retirement. And finally, when you're calculating how much retirement income you'll need, one of the most important expenses you'll need to consider is healthcare. Not only does a longer life expectancy mean more retirement years to plan for, it also means that you'll likely spend more on healthcare for premiums and uninsured expenses. For a married couple, there's a risk that savings may be depleted by healthcare costs relating to the passing of the first spouse, reducing the amount available to the surviving spouse. In addition to general healthcare premiums and expenses, many women will have a need for long-term care because they are more likely to be living on their own in their later years. Long-term care refers to the ongoing services and support needed by people suffering from chronic health conditions or disabilities. It's hard to face the fact that our health might decline, but statistics suggest that 7 out of 10 people will need some type of long-term care services at some point during their lifetimes after age 65. And that type of care can be expensive. Currently, the nationwide average monthly cost of a semi-private room in a nursing home is $7,908. But if you don't need the highest level of skilled care, there are less expensive options, including assisted living facilities, adult daycare centers, and home health care aides. Many people assume that Medicaid will pay for long-term care costs. You may be able to rely on Medicaid, but there's a catch. To qualify for Medicaid, your assets and income must be low enough for you to qualify. You'll have to use up most of your savings before you even qualify for Medicaid. And aside from small personal needs allowance, you'll have to use up all your retirement income, including your Social Security and pension payments, to pay for your care before Medicaid pays anything. Another option to consider is long-term care insurance, which may provide a source of funds for long-term care expenses, but doesn't ensure that you won't have to pay for some of the costs out of pocket. And the premium for this insurance will need to be factored in to your retirement income needs. When we're talking about your personal savings, we're talking about funds that you have in tax-advantaged accounts like IRAs, 401k plans, 457b plans, and 403b plans, as well as any investments that you hold outside of tax-advantaged accounts. When it comes to personal savings, though we've already explained that women face a number of challenges, statistically, women earn less than men in similar jobs, and they're likely to work more part-time. Women also tend to spend fewer years in the workforce due to caregiving responsibilities. Compounding the problem is that women often start saving later and save less than men, which can reduce their chances of having enough income in retirement. The combination of these factors means you might not have enough savings in retirement unless you plan properly. These factors explain why many women are at a disadvantage when it comes to saving for retirement, which makes it vital that they take steps to identify and address any projected shortfall. With all the challenges women face, what can you do? Well, the first is to state the obvious. The number one thing to do is start saving. Set a savings goal that you can work toward and keep track of your progress. Monitor your investments and make changes as needed. A financial professional can help you. If your employer offers a retirement savings plan, such as a 401k or a 403b, start contributing and save as much as you can. If you're contributing the maximum amount to your employer plan and you need additional options, if your employer doesn't offer a retirement plan or you're not currently in a workforce, consider an IRA. We'll talk more about these in a moment. Become a more knowledgeable investor. Some of you here today may have handled your family's finances all along, while others may be new to the world of investing. No matter what your level of expertise, there's always room to learn more and adjust your plan based on your current circumstances. Because many women will end up being solely responsible for their own financial well-being at some point in their lives, it's important they have a sound understanding of the investment world and the confidence to make appropriate investing decisions. Here's an example of how saving a little extra each month could mean a lot during retirement years. Assume that Jane and Sally both earn $50,000 a year from their jobs. Jane saves 6% of her salary each month, while Sally saves 9% each month. If Jane and Sally earn 6% per year on their investments, Jane's savings would be worth $71,724 in 15 years, but Sally's would be worth $107,592. That's nearly $36,000 more. Let's talk a little more about how employer retirement plans and IRAs work. Probably the best way to accumulate funds during retirement is to take advantage of these special tax-deferred retirement vehicles. A 401k plan and other employer-sponsored retirement plans can be very powerful savings tools because your contributions come out of your salary on a pre-tax basis, reducing your current taxable income, and accumulate tax-deferred until withdrawn. Now, withdrawals made prior to age 59 and a half may be subject to an additional 10% penalty. Having contributions deducted directly from your paycheck can make it much easier to sock away money versus saving what you have left over at the end of the month. It may be hard initially to receive a smaller paycheck, but paying yourself first should ultimately benefit you in the long run. Many employers also match a portion of what your contribution amount is. If your 401k plan offers a Roth option, you may be able to contribute to the Roth account. Roth after-tax contributions don't provide you an immediate tax savings, but they do allow you to make withdrawals free of federal taxes down the road. And finally, 401k plans often include employer matching, which should make them your first choice in saving for retirement. You should try to contribute at least enough to receive the full employer match because it's essentially free money. Traditional Roth and spousal IRAs can be used to save for retirement and offer tax advantages. And beginning at age 50, there are catch-up contributions where you can do an additional $8,600 in contributions this year. What can you do if you discover that after factoring in your personal savings, your projected income, you still won't meet your projected expenses in retirement? The best solution for dealing with a shortfall will depend on the severity of your projected deficit, the length of time remaining before retirement, and how long you need your retirement income to last. But consider one or more of these options. Spend less during retirement. Delay retirement, maybe work a little longer. Work during retirement. Maybe you find a less stressful, fun job. Find other potential sources of retirement income. Let's talk briefly about each of these options. As you might expect, delaying retirement offers certain advantages when it comes to retirement income planning. The longer you work, the longer you'll be able to continue contributing to your retirement savings. Even if you're no longer adding to your retirement savings, delaying retirement postpones the date when you'll need to start withdrawing from your savings. And a shorter distribution period could significantly enhance the potential for your savings to last throughout your retirement. As we discussed earlier, delaying retirement may mean you can postpone claiming Social Security retirement benefits, potentially increasing your annual benefit when you do begin turning on Social Security. And continued employment may also result in a continued access to company-sponsored health insurance and provide continued opportunities for social interaction, structure, and certainly a sense of purpose. If you do work during retirement, you will want to make sure that you understand how income you earn might affect your Social Security benefits. While your earnings may increase your Social Security benefits in future years, current benefits could be reduced. For example, for the years before you reach full retirement age, $1 in Social Security benefits will generally be withheld for every $2 you earn over the annual earnings limit. This year, that number is about $24,000 and change. Special rules apply in the year that you reach full retirement age, meaning you can earn more before that withheld rule applies. One last observation on this topic: if you're working for an employer that offers a traditional pension, determine whether working part-time will affect your benefits. If your benefit is based on your final average pay, it's possible that working part-time could reduce your pension benefit. It could also be worth inquiring about a phased retirement program that your employer might offer. These programs allow you to receive all or part of your pension benefit while you continue to work on a part-time basis. Finally, think about other potential sources of retirement income that might be available to you. For example, if you have built up substantial home equity, it's possible that you could tap that equity as a source of retirement income, either by selling the home and possibly downsizing or borrowing against the value of the home. such as with a reverse mortgage. Certainly that course should be explored with caution. Here's another example. An existing permanent life insurance policy that has accumulated cash value can sometimes be used as a source of retirement income. Although policy loans and withdrawals can reduce the cash value, reduce or eliminate the death benefit of the policy, and have a negative tax consequence. So again, proceed with caution. Unfortunately, life isn't always fair or easy. Life happens. Employees are let go. Children come along before we're ready. Couples divorce. Illnesses spring up. Adult children need financial support. Our parents may need our support, and spouses pass away. When you take steps to strengthen your financial future, not only will you be in a better position to enjoy life in the good times, but you'll also be in a better position to cope during the not so good times, which many of us are likely to face. So let's recap. Understand your savings challenges. Be aware of the impact of inflation and taxes on your savings. Plan for income sources and potential gaps to safeguard your security. So I'm going to wrap up where we started and provide you all the different ways that we can help you. Retirement planning, we talked a lot about that today. Social Security, 401ks, investing, getting you smart on how to do that and the different options out there. Life events, we've talked a bit about that today, being out of the workforce, divorce, death, those kinds of things. And then generational planning, again, estate planning, and discussing healthcare and family healthcare. So thank you for joining us today. Here's my contact information, and I look forward to meeting you soon.